Now speaking, Cameron McLaughlin, Head of Investor Relations. Gap Incorporated's first quarter fiscal 2023 earnings call revealed that the company is subject to risks that could cause actual results to differ significantly from forward-looking statements. The company referenced their latest earnings release, annual report on Form 10-K filed with the Securities and Exchange Commission on March 14, 2023, as well as any subsequent filings with the SEC as sources of information regarding these risk factors. Joining the call were Interim Chief Executive Officer Bobby Martin and Chief Financial Officer Katrina O'Connell. Now speaking, Bobby Martin, Chief Executive Officer. Gap Incorporated is taking the necessary actions to drive critical change and improve the trajectory of its business. It is focusing on near-term execution, customer focus, simplifying operations, reducing costs, improving decision-making speed, and modernizing core capabilities. The company delivered 600 basis points of adjusted operating margin expansion in Q1, driven by reduced air freight expense and improved promotional activity, as well as SG&A leverage. Old Navy had market share gains because of strength in women's apparel and a reversal of trend in baby, while Gap saw strength in women's, modest improvement in baby, and weakness in kids and active. Banana Republic is establishing itself as a premium lifestyle brand with BR Home Collection and Athleta faced product acceptance challenges due to straying from its performance DNA. The organization has been flattened from 12 to 8 layers and average span of control increased from 2 to 4 people. G&A functions have been centralized and approximately 1,800 positions have been eliminated, resulting in estimated annualized savings of $550 million. A transformation office has been put in place and external consulting partners engaged to drive changes. CEO search is still underway and incentive compensation aligned to cost transformation efforts. Now speaking, Katrina O'Connell, Executive Vice President, Chief Financial Officer. And we expect ROD, as a percentage of sales, to delever by approximately 50 basis points versus last year. Gap Incorporated reported first quarter net sales of $3.3 billion, down 6% from the prior year and consistent with expectations for mid-single-digit declines. Comparable sales were down 3%, driven by continued strength in women's at Gap and Old Navy, offset by weaker sales at Athleta. Adjusted gross margin improved 570 basis points to 37.2%, driven by 560 basis points leverage on air freight expenses, 330 basis points of deleverage due to inflationary cost headwinds, and 380 basis points of leverage stemming from improved promotional activity. Adjusted SG&A decreased 7% from the prior year and leveraged 60 basis points, driven by lower advertising expense and lower technology investments. Adjusted operating income was $18 million and adjusted operating margin improved 620 basis points to 0.5%. The company ended the quarter with cash and equivalents up 38% to nearly $1.2 billion. For Q2, Gap Incorporated is expecting total net sales to be down mid to high single digits year-over-year, reflecting an estimated 1-point foreign exchange headwind and the impact of the sale of Gap China. Gross margin is expected to improve 200 basis points compared to last year, driven by air freight leverage and improved promotional activity, partially offset by inflationary cost headwinds. Adjusted SG&A is expected to be approximately $1.3 billion. For full year 2023, Gap Incorporated expects net sales to be down in the low to mid-single-digit range and adjusted gross margin to improve 200 basis points compared to fiscal 2022, driven by air freight leverage, partially offset by inflationary cost headwinds. Morgan Stanley analyst Alex Stratton inquired, "Can you give us any insight on the quarter's revenue trend? Did it remain consistent or did it change throughout the quarter? Additionally, why does the 2Q guidance assume a worsening from the first quarter levels? Is there any particular segment driving this decrease?" Katrina O'Connell replied, "Thanks, Alex. We're pleased to have delivered on our revenue expectations in Q1. Generally, it followed the trend of February being strong due to warm weather and March weakening due to regional bank issues impacting consumer spending. April saw a slight recovery, however it was tempered by lower tax returns. May has seen some softness continue, and we factored that into our outlook for Q2 with a range provided for different scenarios that could play out." J.P. Morgan Chase & Company analyst Matthew Boss inquired, "Bob, what trends are you seeing in Old Navy's market share gains and how do you feel about the balance of your assortments compared to the softer Athleta performance?" Bobby Martin replied, "We're pleased to see the market share gains continuing, particularly in the women's category. We believe that our assortment is still over-assorted and that this period of transition will bring clarity to which categories the brand will thrive in long term. We've been making progress in cleaning up inventory and adjusting product silhouettes, colors and styling. Athleta has been a challenge in terms of not meeting customer needs, but we remain committed to Power of She and are investing in running, yoga and other areas to give customers what they need. We are optimistic that the brand will find its stride again soon. Goldman Sachs analyst Brooke Roach inquired, "Can you discuss the composition of your inventory and your ability to chase into popular products? Do you think this could improve performance in the back half of the year? Additionally, can you provide an update on free cash flow outlook?" Bobby Martin replied, "Our company has experienced an increase in revenue this quarter due to our strategic investments in new product lines. We are confident that these investments will continue to drive growth in the upcoming months." Katrina O'Connell replied, "We are pleased to report that we have been successful in reducing our inventory levels to pre-pandemic levels. The result has been an improvement in our gross margin performance as we have been able to offer value to customers without the need for markdown clearance. We have recently reinstated our responsive capabilities and made organizational changes which have given us better insight into overall inventory management, allowing us to chase trends more effectively across all of our brands." Bobby Martin replied, "In response to the question about expectations around the back half, I'm confident that our supply chain capabilities and collaboration with vendors have allowed us to leverage our core strengths. We're seeing success in getting back to discipline and rigor, which gives us great confidence in our performance during the second half of the year." Katrina O'Connell replied, "In Q1, our disciplined inventory and expenses management combined with improved operating performance gave us confidence in our free cash flow outlook. Free cash flow outflow was $102 million, which is in line with seasonality and back to a normalized level. We even saw an unusually low outflow for this quarter. Our goal is to generate positive free cash flow through better operating performance." Bank of America Merrill Lynch analyst Lorraine Hutchinson inquired, "Can you discuss where margins are at pre-COVID levels for Old Navy and the reaction to recent price increases?" Katrina O'Connell replied, "Yes, Lorraine. Thanks for your question. The margin benefit we saw in the quarter was largely due to a reduction in inventory and markdown costs, which don't offer customer value. This allowed us to still promote and offer value to our customers. Price increases have not resulted in adverse reactions, as they were targeted to items that are important to consumers right now, like wovens, pants, and fashionable items. We're still better off than pre-pandemic with promotions remaining competitive." Bank of America Merrill Lynch analyst Lorraine Hutchinson inquired, "Could you provide more insight into the promotional environment, including differences among income cohorts and demographics? What assumptions are you making regarding timing for the rest of the year, with the approach of back to school?" Katrina O'Connell replied, "Our income cohort demographic continues to be similar to what was seen in the back half of Q1. In areas where there is a low-income consumer, we are seeing contraction in spending and higher price sensitivity. Where we have higher-income consumers, they remain less price-sensitive and continue to spend. This dynamic contributes to our revenue performance range. We've had to do less promotion to clear inventory due to more balanced inventories, and our promotions have been focused on adding value to consumers, which should drive more revenue." Jefferies analyst Corey Tarlow inquired, "Katrina, could you provide an update on the Gap store fleet and Old Navy's improvement? What work still needs to be done and how far along are we in this process?" Katrina O'Connell replied, "Overall, we have closed or will have closed by the end of this year over 350 Gap and Banana stores. We have completed most of our restructuring activity, leaving a relatively healthy fleet. Regarding Old Navy, we've seen gains in women's but need to continue to work on men's and kids. Activewear has gained share over multiple years, but there is still work to be done to ensure the assortment is current." Bobby Martin replied, "We're seeing progress in Old Navy as we work to rationalize our assortment, balance inventory and design for brand relevance and fashion. We're also increasing our marketing effectiveness with the right promotional approach and working on a value proposition that competes in the marketplace. The team is focused on diagnostics both online and in-store, bringing together the experience of both, and all of these efforts are expected to bring improvements to Old Navy." Robert W. Baird & Company analyst Mark Altschwager inquired, "Can you provide more color on the Q1 gross margin benefit from promo recapture and how that dynamic impacts the top-line outlook?" Katrina O'Connell replied, "In Q1, we saw modest upside from freight and bigger upside from reduced discounting. We expect to offset at least 200 basis points of inflationary pressure with discounts in Q2, and at least 100 for the full year. Our discount rate may increase depending on how consumers behave, which will determine whether we'll see revenue upside or if we'll have to compete harder." Barclays analyst Paul Carney inquired, can you elaborate on the cost-cutting and streamlining initiatives implemented this year? How will these changes improve responsiveness in the organization? What other measures can be taken to ensure sustainable savings? Bobby Martin replied, our efforts to reduce overhead from 12 layers to 8 and improve our span of control have been key to improving efficiency, agility, and responsiveness. We've worked hard to restructure our SG&A in a manner that enables us to remain competitive. Our focus now is on creating a mindset change and culture shift that encourages continuous improvement and heightened customer responsiveness. We are pleased with the progress we have made thus far, but understand there is still much work to be done. Katrina O'Connell replied, we are very pleased with the cost savings that have resulted from our organizational changes, as well as some marketing and technology cost savings we secured last year. We have identified more opportunities in those areas and will continue to work on them once our organizational structures are settled. JJK Research Associates analyst Janet Kloppenberg inquired, can you outline the assumptions for the second quarter on promotion and recapture, as well as the outlook for kids and men's categories? Also, what is the outlook for denim and inventory going forward? Katrina O'Connell replied, on the gross margin and promotional trends, we expect there to be a range of outcomes for both kids and men's in Q2 and beyond, as reflected in our guidance. Regarding denim, we've seen good momentum heading into back to school, with share gains in Q1. Katrina O'Connell replied, inventories are expected to be down significantly more than our sales guide. We ended Q3 at 27% lower than last year, and we will continue to closely manage inventories going forward. The retail tracker analyst Marnie Shapiro inquired, could you provide an estimated timeline for when the changes with color, print, and better balance will show up in Athleta stores? Are these expected to be ready for back to school and the fall season, and winter gifting? Do you need new leadership in place to begin innovating in the performance market, as some of the styles have become stale? Bobby Martin replied, to answer your question, we are leveraging the talents of our current team and adding new perspective with Julia Leach, who is contributing to our creative direction. While fabrications may take some time to implement, we are taking advantage of every opportunity to make adjustments where possible for fall and holiday. We understand what the brand stands for and will continue to strive to exceed expectations. The retail tracker analyst Marnie Shapiro inquired, can you explain how you plan to address the risk of shoppers becoming accustomed to discounts as you work to clear out inventory? Katrina O'Connell replied, Marnie, our goal is to drive the business through fashion authority, innovation and positioning, reducing reliance on promotions. The team is working toward this long-term objective.